Hey, what's going on, family? Welcome to part three of the free prepared tax course. Once again, sorry about the technical difficulties from the last part of those 3 minutes. I just didn't unmute myself, but I will make sure moving forward that I continue to do that. So what we're going to do is we're going to start back with the ethics portion of the course. Um, yeah, we're going to go ahead and start back with that. Then we're going to
Welcome
get
to
into
the part 2 of
then we're
ethics,
going to actually get
fundamental.
into due diligence. We're going to get into due diligence, and then we're going to get into income, and then that will be the end. I will be keeping this up for about 5 days, and I also will be sending you guys an assessment. Based on that assessment, I will be picking one person to take the free advanced course. Um, and then we'll go ahead and go from there. Once you guys are in the group, we're going to be doing a lot of different things. I'm going to be going live a lot, and I'm going to be giving you guys the opportunity to ask me a lot of questions. So once again, thank you guys, and here you guys go.
Principles of ethics. Competence is a fundamental principle in tax professional ethics that emphasizes the importance of maintaining professional knowledge and skill to provide competent service to clients. As a tax professional, it is your duty to stay updated, stay abreast of the latest tax laws, regulations, and industry developments relevant to your client's tax situations. Continuously update your knowledge and skills through professional development and ongoing education. Provide accurate advice. Ensure that your advice and recommendations to clients are accurate, reliable, and based on a thorough understanding of their specific tax circumstances. Be prepared to answer their questions and address any tax-related concerns they may have. Seek assistance if needed. Recognize the limits of your own expertise and seek assistance or collaborate with other professionals when dealing with complex tax matters that are beyond your level of competence. Referring clients to specialists when necessary demonstrates responsible and ethical practice. Now, let's move on to an example that illustrates the importance of competence in tax professional ethics. Meet Julian. Julian is filing taxes for the first time. He's 21 and lives at home with his parents. Julian also works and shares a 2-year-old son with his ex-girlfriend. Julian states that he heard he could get up to $8,000 back for claiming a child and wants to claim his son. Julian has provided you with his W-2 SSN cards for him and his son, and his son's birth certificate. What do you do? In the previous example, it is essential for a competent tax professional to educate clients properly and address any misconceptions they may have. Let's delve deeper into this concept. When dealing with new clients like Julian, it is common for them to have expectations based on hearsay or misinformation. In this case, Julian's belief that he can claim a substantial tax benefit for his son may stem from inaccurate information from others. As a competent tax professional, you should gather relevant information. Ask Julian additional questions about his son, such as custody arrangements, support provided, and the residency of the child. This will help determine his eligibility to claim the child as a dependent for tax purposes. Educate on eligibility criteria. Provide Julian with accurate information about the eligibility criteria for claiming a child as a dependent. Explain the IRS rules regarding custody, support, and residency requirements, ensuring that he understands the factors that determine his eligibility. Correct misinformation. Address any misconceptions or inaccurate information that Julian may have received from unreliable sources. Clarify the requirements and limitations associated with claiming a child as a dependent, emphasizing the importance of adhering to the tax laws and regulations. By educating clients like Julian, you empower them with accurate information and help them make informed decisions regarding their tax returns. This not only demonstrates your competence as a tax professional, but also upholds your ethical obligation to provide reliable advice based on accurate knowledge. In the subsequent slides, we will explore more examples and ethical considerations related to competence in tax professional ethics. Meet Julian. You ask Julian who does his child live with. Julian replies that the child lives with the mother for 8 months and 4 months with him and his parents. Based on the evaluation of Julian's custody arrangements and residency, it is important to provide him with accurate advice and set realistic expectations regarding his ability to claim his son as a dependent. Here's how you can handle the situation. Inform Julian of ineligibility. Explain to Julian that based on the custody arrangements and residency of his son, he does not meet the requirements to claim his son as a dependent for this tax year. Clearly communicate the reasons why he is ineligible, emphasizing the importance of meeting the IRS requirements. Educate on future eligibility. Advise Julian that if he wants to claim his son as a dependent in the future, he needs to ensure that he meets the residency and other eligibility criteria set by the IRS. Explain that maintaining accurate records and proper documentation will be crucial to support his claim. Set realistic expectations. Manage Julian's expectations by informing him that claiming a dependent child does not automatically result in receiving a substantial tax benefit, such as an $8,000 refund. Explain that the tax benefits associated with claiming a child depend on various factors, including income, credits, and deductions. Highlight audit risks. Inform Julian that claiming a dependent, particularly as a father, may increase the likelihood of an IRS audit. Emphasize the importance of maintaining accurate records, including custody agreements, support payments, and other relevant documentation to substantiate his claim if audited. By providing Julian with this advice, you demonstrate competence in guiding him through the proper procedures and setting realistic expectations. This ethical approach ensures that Julian understands his tax situation and makes informed decisions for future filings. Next slide is confidentiality. Confidentiality is a fundamental principle in the ethical practice of tax professionals. As a tax preparer, you have a duty to respect the confidentiality of information obtained from your clients and to refrain from disclosing it to third parties without their consent. Consider the following points regarding confidentiality. Client information. Safeguard all client information obtained during the course of your professional engagement. This includes personal and financial details, tax returns, and any other sensitive information shared with you. Written consent. Obtain written consent from clients before disclosing any confidential information to third parties, such as other professionals or government agencies. Ensure that clients are aware of the purpose and scope of the disclosure and that their privacy rights are protected. Secure data handling. Implement proper measures to secure client data and protect it from unauthorized access, loss, or theft. This may involve using secure file storage systems, encryption methods, and maintaining appropriate physical and electronic security protocols. Professional obligation. Maintain confidentiality even after the termination of the client engagement. Respect the privacy and confidentiality of former clients and refrain from disclosing any information without their explicit consent. By upholding confidentiality, you build trust with your clients and demonstrate professionalism in your practice. It is essential to prioritize the privacy and security of client information at all times. In the subsequent slides, we will explore more examples and considerations related to confidentiality in tax professional ethics. Meet John and Nick. John provides portions of the year-end brokerage statement. Nick provides the complete brokerage statement, including the original and amended statements and all disclosures the broker provided. You then ask John for additional information to inquire if the client received an amended statement based off what Nick provided. Did you break confidentiality? Let's consider the example of John and Nick to understand the importance of maintaining confidentiality in your practice. In this scenario, John and Nick are both clients who provide you with brokerage statements for tax preparation. John provides portions of the year-end brokerage statement, while Nick provides the complete statement, including the original and amended statements, as well as all disclosures provided by the broker. As a tax professional, it is crucial to respect the confidentiality of client information. In this case, it is not a breach of confidentiality to ask John for additional information to see if he received an amended statement. This is because you are seeking clarification specific to John's situation and not disclosing information from Nick's return. However, it would be a breach of confidentiality to discuss detailed information from Nick's return with John, such as disclosing his income or tax liability. Each client's information should be treated with utmost confidentiality and not shared without their explicit consent. By maintaining strict confidentiality and handling client information with care, you uphold the ethical standards of your profession and build trust with your clients. Next slide is professional behavior. Professional behavior is a crucial aspect of ethical practice for tax preparers. It involves complying with relevant laws and regulations, conducting oneself in a manner that upholds the reputation of the profession, and treating others with courtesy and consideration. Here are key points related to professional behavior. Compliance with laws and regulations. Adhere to all applicable laws, regulations, and professional standards governing tax preparation. Stay updated on changes in tax laws and ensure that your practices align with the latest requirements. Ethical conduct. Conduct yourself in a manner that reflects positively on the tax profession. Avoid engaging in any behavior that could bring disrepute to yourself or the profession. Act with integrity, honesty, and professionalism at all times. Courtesy and consideration. Interact with clients, colleagues, and other stakeholders in a respectful and considerate manner. Maintain open and effective communication. Listen to client concerns and address them appropriately. Treat everyone with fairness and without discrimination. By embodying professional behavior, you demonstrate your commitment to ethical practice and build trust and confidence with your clients and the public. That's the end of the fundamental principles of ethics.
Right, Charles. So once again, they go over ethics a lot, but it also goes over some scenarios where you really need to figure out whether this person could claim this child, and that's important because the another thing about this profession is when you send off their return, you have to check. Sometimes they get rejected. Sometimes they get rejected, and then in that rejection, what happens is now you have to figure out what it is, and then maybe they can't claim the child. Now their refund is reduced significantly, and they may actually they have been able to claim the child. So then what will happen in that scenario is now you have to file it on paper. You have to file some other paperwork to go with it, and you're gonna have to get a contract signed with your client, or maybe make them pay up front because that funding is not going to come straight to you. It's actually going to come straight to them now. All right. So you're hoping that ethics plays a part for them as well. So you may have to come up with some agreements. But at the same time, this is a part of understanding the tax game. Sometimes when I talk to clients who I know may be in this scenario, before I even start typing, I get all the answers I need in that scenario. I make sure that nobody's claimed them. I ask them. I ask them all those questions to make sure we're really not wasting their time. All right. Because part of ethics is making sure, it's customer service and making sure that their time's not wasted, but also making sure yours. That's okay to make sure that your time's not wasted. All right, y'all. So just make sure that this is very, very good stuff to pay attention to, because some of these situations could get sticky. They could get very sticky, you know what I'm saying? So you want to make sure that in those sticky situations you're acting, you're upholding your ethics, but you're just also protecting yourself and protecting your time. You know what I'm saying? So here's our best practices for tax professionals is up next, and then we're going to get into a couple other sections.
Welcome to the last section of Ethics module, the best practices for tax professionals. As a tax professional, it is essential to uphold high ethical standards, maintain competence, and provide exceptional service to your clients. This module will explore key best practices that will help you excel in your role and ensure a successful and ethical tax practice. In the subsequent slides, we will explore more best practices for tax professionals. First, communicate with clients. It is crucial to establish clear and consistent communication with your clients throughout the engagement process. By keeping your clients informed, you build trust, manage expectations, and ensure a smooth working relationship. Here are some key aspects of communicating with clients. Sending emails. Utilize email communication to share important information, updates, and documents. Email provides a written record that both you and your clients can refer to as needed. Ensure your emails are professional, concise, and address any specific questions or concerns. Making phone calls. Schedule regular phone calls with your clients to discuss their tax matters. This allows for a more personal and interactive conversation, enabling you to address any complexities or clarify information. Phone calls also provide an opportunity for clients to ask questions and receive immediate feedback. Sending texts. In certain situations, where appropriate and with client consent, you may use text messaging for quick updates or reminders. However, be mindful of the nature of the information being conveyed and ensure compliance with any applicable privacy or confidentiality regulations. Remember, effective communication goes beyond simply relaying information. It also involves actively listening to your clients, understanding their concerns, and providing clear explanations in a language they can understand. Regular and transparent communication fosters a positive client experience and sets the foundation for a long-term professional relationship. In the next section, we will explore another vital best practice: establishing facts. Second, establish facts. By ensuring the accuracy of the information you rely on, you can provide informed and trustworthy tax advice. Here are key considerations for establishing facts. Determine relevant facts. Ask thorough and probing questions to gather all necessary information from your clients. Identify the key details and ensure you have a comprehensive understanding of their tax situation. This allows you to provide tailored and accurate advice. Verify with proof. Never solely rely on hearsay or unsubstantiated claims. Always verify the facts by requesting supporting documents and evidence from your clients. This can include pay stubs, bank statements, receipts, or any other relevant records. Verifying information ensures the integrity of your work and helps you avoid potential errors or misinterpretations. Seek trusted advice. If you encounter complex or unfamiliar scenarios, don't hesitate to seek guidance from trusted and credible sources. Consult with other experienced tax professionals or refer to reliable resources, such as tax publications or professional organizations. Being open to learning from others enhances your knowledge and helps you provide accurate advice to your clients. By diligently establishing facts, you demonstrate professionalism, attention to detail, and a commitment to delivering reliable tax services. The next slide will focus on the importance of being teachable as a tax professional. Let's proceed to the last slide about being teachable. Lastly, be teachable. Being teachable enables you to provide accurate and relevant advice to your clients. Here are some ways to embrace a teachable mindset. Research. Dedicate time to research and study tax laws, updates, and relevant publications. Stay informed about changes in tax legislation, IRS guidelines, and any other developments that may impact your client's tax obligations. Utilize reliable sources such as government publications, tax journals, and reputable online resources. Attend trainings, webinars, and seminars. Take advantage of professional development opportunities by attending trainings, webinars, and seminars. These events provide valuable insights from industry experts, allow for interactive learning, and keep you up to date with the latest tax practices and strategies. Stay engaged in continuing education to enhance your expertise. Network with tax professional peers. Engage with other tax professionals by joining professional organizations, attending conferences, or participating in networking events. Interacting with peers provides a platform to share knowledge, exchange ideas, and learn from their experiences. Collaborating with others in the field can expand your perspective and contribute to your professional growth. By remaining teachable, you demonstrate a commitment to excellence and ongoing learning. Embrace these best practices to stay at the forefront of your profession and deliver the highest level of service to your clients. Congratulations on completing the module. Remember to incorporate these practices into your daily work to enhance your professional effectiveness. See you in the next module.
That's the end of, I know that's the end of the ethics portion. So we're going to get next into due diligence requirements. There's about 4 different sections for that. And then we have 3 sections for income, and then that would be the completion of the course. Like I said, guys, I know a lot of this stuff, it's not, the most interesting, but once you get into this game, and like I said, this game is about building your book of business. This is about 20 to 30 years from now, maybe being able to hand this to your kids, grandkids, whoever. All right. This is all important stuff that you need to know. Everything that I teach after this is additional, it's money making, it's very much a part of the tax game. But this is the foundation of it, all right? This is the foundation. So what we're going to do next, we're going to go ahead and get into due diligence. All right, we're going to go ahead and get into that. And then once again, I appreciate you guys for your patience. I appreciate you guys for showing up and doing what you need to do.
As a tax professional, it is crucial to exercise due diligence in your work to ensure accuracy, compliance, and ethical conduct. This module will explore the concept of due diligence and its significance in the tax profession. We will delve into key aspects and best practices to help you navigate this essential aspect of your role. Let's start with the due diligence requirements. As a tax professional, it is essential to meet 4 specific due diligence requirements when preparing tax returns or claiming tax benefits on behalf of your clients. Failure to fulfill these requirements can lead to penalties imposed against you. These requirements ensure that tax professionals maintain a high standard of accuracy, compliance, and ethical conduct in their work. As a paid tax return preparer, you must 1. Complete and submit Form 8867. 2. Compute the credits based on the facts. 3. Have knowledge. 4. Keep records for 3 years. Let's dive in them one by one. As a tax professional, one of the due diligence requirements is to complete Form 8867, the Paid Preparer's Due Diligence Checklist. This form collects important information regarding the taxpayer's eligibility for certain tax benefits. In order to meet this requirement, you must complete Form 8867 accurately and thoroughly. When preparing a client's tax return or claim for refund, you must gather all the necessary information to determine their eligibility for certain tax benefits. This includes verifying their qualifications for credits, deductions, or exemptions. Electronically submit the completed Form 8867 to the IRS. If you are filing the tax return or claim electronically, you must electronically submit the completed Form 8867 along with the filing. This ensures that the IRS receives the form and can review your due diligence efforts. Provide a copy of the completed Form 8867 to your client. If the return is not being filed electronically, you are required to provide a copy of the completed Form 8867 to your client. They should include it when filing their return or claim for refund. This allows the IRS to have access to the form as part of their review process. By completing and submitting Form 8867, you demonstrate that you have conducted a thorough review of the taxpayer's eligibility for specific tax benefits. This helps ensure compliance with the due diligence requirements and promotes the accuracy and integrity of the tax filing process. Next, compute the credits. Once you have gathered all the necessary information from your client or other reliable sources, you need to compute the credits accurately. This involves completing the appropriate worksheets provided in the instructions for Form 1040 or Form 8863, depending on the specific tax credit being claimed. For example, if your client is eligible for the child tax credit, you would use the worksheet provided in the Form 1040 instructions to determine the amount of the credit based on the taxpayer's qualifying children and their adjusted gross income. It is crucial to ensure that you are using the correct worksheets and following the instructions accurately to compute the credits correctly. This step requires attention to detail and a thorough understanding of the tax laws and regulations related to each specific credit. Keep records of computations and information used. As a tax professional, it is important to maintain proper documentation of the computations you have made and the information you have used to determine the credits. This includes keeping records of the worksheets completed, any calculations made, and the sources of information relied upon. These records should clearly demonstrate how you arrived at the credit amounts claimed on the tax return or claim for refund. By completing the computations accurately and maintaining proper records, you demonstrate your commitment to meeting the due diligence requirements and ensuring the integrity of the tax filing process. To meet the due diligence requirement, you must exercise knowledge and understanding of the tax laws related to the credits or head of household filing status being claimed. This involves the following. You must not know or have reason to know that any information provided by your client or otherwise known to you is incorrect. If you have any doubts or suspicions about the accuracy of the information, you should make reasonable inquiries to obtain correct and complete information. You cannot ignore the implications of any information given to you or known to you. If something appears inconsistent or questionable, it is your responsibility to address and clarify it with your client. During the client interview, you should ask relevant questions to gather accurate information about the taxpayer's eligibility for the claimed credits or HOH filing status. It is important to document these inquiries and your client's responses as part of your due diligence records. As a tax professional, you are expected to have knowledge of the tax laws and regulations that pertain to the specific credits or filing status being claimed. This knowledge enables you to ask the right questions and ensure that all relevant information is obtained from your client. By applying your knowledge of the tax laws and using it to guide your client interactions and information gathering, you can fulfill the third due diligence requirement and ensure compliance with the regulations. Keep records for 3 years. To meet the due diligence requirements, you must maintain proper records of your due diligence efforts. This includes keeping a copy of the completed Form 8867, Pay Preparer's Due Diligence Checklist, for each return or claim you prepare. Maintaining a record of how, when, and from whom you received the information used to complete Form 8867 and the worksheets. This includes documenting any interviews, conversations, or documents provided by your client. Keeping copies of any documents or records your client showed you and that you relied upon to complete the Form 8867 or the worksheets. This ensures that you have evidence to support the accuracy and validity of the information used. It is important to maintain these records for a minimum of 3 years from the due date of the return or the date the return was filed, whichever is later. These records should be organized and readily accessible for review in case of an IRS inquiry or audit. By maintaining thorough and well-documented records, you can demonstrate your compliance with the due diligence requirements and provide evidence of your diligent efforts as a tax professional.
All right, y'all. So as you can see on the bottom, 8867, she brought that form up. It cut 88,000. But 8867 and 8879, those are two forms that kind of are checklists to make sure that everything's accurate and that you ask all questions. They will be required. It's also going to be a form required where you have to submit their ID information for verification. So when it comes down to things like that, the software will not just let you bypass. There will be times where you might not have to do it based on the client's filing situation. But for the most part, when you have people doing businesses, Schedule Cs, different stuff like that, it will be a requirement for them to have that form complete. So just wanted to go over that real quick before we move on to our next due diligence portion with qualified children. All right, so give me one moment. I'll go ahead and get on that for you guys.
Fourth module of our training program, where we'll dive into the important topic of due diligence with qualified children and relatives. As tax professionals, it's crucial that we understand the specific requirements for claiming credits like the child tax credit and other dependents credit. By ensuring we meet the due diligence requirements, we can accurately determine eligibility and provide our clients with the best possible guidance. So let's explore the key tests and considerations when it comes to qualified children and relatives. Are you ready? Let's get started. We will be diving into the essential requirements that must be met in order to claim credits such as the Child Tax Credit, CTC, or other dependents credit, OG. It's important that we understand these requirements to accurately determine if a dependent can be considered qualified for tax purposes. To establish whether someone qualifies as a dependent or relative, we need to assess their eligibility based on several tests. These tests include age, relationship, residency, support, and the gross income test. Each test plays a vital role in determining if a child or relative can be claimed as a qualified dependent. So let's explore each of these tests in detail and understand what they entail. Without further ado, let's begin with the first test. Age. The first test. The age test for a qualified child. This test is crucial in determining whether a child can be claimed as a dependent and qualify for credits, such as the Earned Income Tax Credit, EIT, or the Child Tax Credit, CTC. To meet the age test, the child must fall into one of the following categories. 1. Under age 19 at the end of the year and younger than you or your spouse if filing jointly. 2. A full-time student under age 24 at the end of the year and younger than you or your spouse if filing jointly. 3. Permanently and totally disabled at any time during the year, regardless of age. It's important to note that for the year 2023, in order to claim the child tax credit, the child must be under the age of 17. As tax professionals, it's our responsibility to gather accurate information about the child's age and verify their eligibility based on these criteria. This ensures that our clients receive the appropriate tax benefits they're entitled to while maintaining compliance with IRS regulations. Let's move on to the next test, the relationship test. Let's explore the second test, the relationship test for a qualifying child. This test focuses on the relationship between the taxpayer and the dependent, determining whether the child meets the necessary criteria to be claimed as a dependent. To meet the relationship test, the child must fall into one of the following categories: son or daughter. This includes biological children, stepchildren, and legally adopted children. Eligible foster child. A child placed with you by an authorized placement agency or by court order. Grandchild, niece, or nephew. These are children of your son, daughter, stepchild, or adopted child. Brother or sister. This includes full siblings, half-siblings, and step-siblings. It's important to accurately determine the relationship between the taxpayer and the dependent based on these categories. This ensures that the taxpayer meets the requirements to claim credit such as the child tax credit or the other dependent's credit. Now that we've covered the relationship test, let's move on to the next test, the residency test. Great job! Now, let's discuss the relationship test for a qualifying relative. This test determines whether a relative meets the criteria to be claimed as a dependent. To meet the relationship test, the relative must fall into one of the following categories. Child. This includes your son, daughter, stepchild, or eligible foster child. Sibling. This refers to your brother, sister, stepbrother, or stepsister. Parent. This includes your biological or adoptive parent or step-parent. Grandparent. Your biological or adoptive grandparent qualifies. Niece or nephew. These are the children of your brother, sister, stepbrother, or stepsister. Aunt or uncle. Your aunt or uncle on either your mother's or father's side qualifies. Certain in-laws. This includes your mother-in-law, father-in-law, daughter-in-law, son-in-law, sister-in-law, or brother-in-law. Step-relative. This includes stepchildren, step-grandparents, step-siblings, and other step-relatives. It's crucial to accurately determine the relationship between the taxpayer and the qualifying relative based on these categories. This ensures that the taxpayer meets the requirements to claim the applicable credits or deductions. Now that we've covered the relationship test for qualifying relatives, let's move on to the next test, the residency test. Let's delve into the remaining tests for qualifying children and relatives. The support test and the gross income test. For the support test, it is important to determine if the child or relative has provided more than half of their own support. As the taxpayer, you should gather information about the financial contributions made by the child or relative and compare it to the total support they received. If you or other individuals provided more than half of their support, they would meet the requirement for this test. Remember that the same residency rule applies to relatives, except that they must have lived with the taxpayer for the entire year. Now, let's move on to the last test, the gross income test. The final test, the gross income test for qualifying relatives. To meet this test, the person's gross income must be less than the exemption amount. For the year 2023, the exemption amount is set at $4,400. As the tax professional, it is important to gather accurate information about the relative's gross income and compare it to the exemption amount. If their gross income is below $4,400, they would meet the requirement for this test. Remember, these tests are crucial in determining if a dependent qualifies for credits, such as the child tax credit or other dependents' credit. As a tax professional, it is your responsibility to ensure that these tests are properly applied to determine the eligibility of the taxpayer's dependents. Now, let's talk about the support test for qualifying relatives. To meet this test, the taxpayer must have provided more than half of the person's total support for the entire year. When we talk about support, it includes various items such as food, clothing, shelter, education expenses, and medical and dental care. It's important to gather accurate information about the financial support provided to the relative and compare it to the total support they receive from all sources. As a tax professional, it's essential to ensure that you have documentation and evidence to support the taxpayer's claim regarding the support provided. This may include receipts, bills, or other relevant records. Remember, meeting the support test is crucial in determining if a relative qualifies as a dependent for tax purposes. It's your role as a tax professional to accurately assess and document the taxpayer's support for their relative. Now let's move on to discussing the due diligence requirements for three important refundable credits: the Earned Income Tax Credit, EIC, the Child Tax Credit, CTC, and the Other Dependent Credit, OC, and American Opportunity Tax Credit, AOC. Earned Income Tax Credit, EIC. The EIC is a valuable credit for eligible taxpayers with low to moderate incomes. Child Tax Credit, CTC. The Child Tax Credit provides tax relief for taxpayers who have qualifying children. It is essential to exercise due diligence when claiming the CTC to ensure the taxpayer meets the eligibility requirements. Other Dependent Credit, OC. The Other Dependent Credit allows taxpayers to claim a credit for dependents who may not meet the qualifying child criteria for the CTC. Similar to the CTC, due diligence is necessary when claiming the ODC. American Opportunity Tax Credit, AOC. The AOC provides tax benefits for eligible taxpayers who are pursuing higher education. As a tax professional, it is crucial to exercise due diligence when claiming the AOC for your clients. Remember, complying with the due diligence requirements for these refundable credits is essential to prevent errors, inaccuracies, and potential penalties. By fulfilling your responsibilities as a tax professional, you help maintain the integrity of the tax system and ensure that your clients receive the credits they are eligible for. Keep on learning. Let's now go to the next section. Welcome to the next section of due diligence module. This section is about most common EIC errors. To ensure accurate and compliant tax filings for clients claiming the Earned Income Tax Credit, EIC, it's important to be aware of the most common errors that can occur. By identifying and avoiding these errors, tax professionals can provide reliable and trustworthy services to their clients. In this section, we will discuss the most common EIC errors and provide insights on how to prevent them. One of the most common errors in EIC filings is claiming the credit for a child who does not meet the eligibility requirements. To claim the EIC, the child must meet certain criteria such as age, relationship, residency, support, and gross income. It's crucial for tax professionals to thoroughly review and verify these requirements before including a child in the EIC claim. Another common error is filing as single or head of household when the taxpayer is actually married. It's important for tax professionals to accurately determine the taxpayer's filing status based on their marital status and other qualifying factors. Lastly, incorrectly reporting income or expenses can also result in EIC filing errors. Tax professionals must ensure that all income and expenses are accurately reported, taking into account the specific guidelines and requirements set by the IRS. Now that we've discussed the most common EIC errors, let's explore the consequences of filing EIC returns incorrectly. Filing EIC returns incorrectly can have significant consequences for both the client and the tax professional. It's crucial to be aware of the potential ramifications to ensure accurate and compliant filings. Here are some key repercussions. 1. The client must pay back the amount claimed in error, along with any applicable interest. This can result in unexpected financial obligations for the client, leading to potential financial strain. 2. The client may be required to file Form 8862 for up to 10 years. This form acts as a safeguard against erroneous EIC claims, and its filing requirement can impose additional administrative burdens on the client. 3. The client can face a ban of up to 2 years from claiming the EIC if they are found to have disregarded the rules intentionally or through reckless disregard. This ban can result in the loss of valuable tax credits for the client and may affect their overall tax liability. 4. The client may be banned from claiming EIC for 10 years if the error is because of the fraud. As a tax professional, you may also face penalties, fines, or disciplinary actions for facilitating inaccurate EIC claims. This can damage your professional reputation, result in legal consequences, and impact your ability to practice before the IRS. To mitigate these risks, it's essential to exercise due diligence in determining EIC eligibility, accurately reporting income and expenses, and adhering to the guidelines provided by the IRS. By doing so, you can help clients avoid these consequences and maintain your professional integrity. In determining eligibility for the Earned Income Tax Credit, EIC, asking the right questions is essential to ensure accurate and compliant filings. Here are some key inquiries to make during the client interview. Did the child live with you for over half the year? Determining the child's residency is crucial in establishing eligibility for the EIC. Have you supported the child the entire year? The taxpayer must provide more than half of the child's support throughout the year to qualify for the EIC. Have you ever been disallowed to claim the Earned Income Credit? Inquire whether the taxpayer has been previously disqualified from claiming the EIC. Have you ever had to file Form 8862? Form 8862 is required for taxpayers who have previously been denied the EIC and are now attempting to claim it. By asking these questions, tax professionals can gather the necessary information to accurately determine a taxpayer's eligibility for the EIC. It is important to ensure that all requirements are met to avoid errors and potential penalties. Let's have the scenario of Mark. Mark wants to claim his niece for the EIC and CTC. This information seems incomplete because it is common for a child to live with at least one parent. What additional questions would you ask Mark? Eligibility. Here are some additional questions to ask Mark. Mark wants to claim his niece for the Earned Income Tax Credit, EIC, and Child Tax Credit, CTC. To gather more information and determine eligibility, here are some additional questions to ask Mark. Where are the biological parents of your niece? Determine the custody or living arrangements of the child's parents, as it may impact eligibility for claiming the EIC and CTC. Can anyone else claim your niece as a dependent? Inquire if there are any other individuals, such as the child's parents or another guardian, who may have a valid claim to claim the niece as a dependent for tax purposes. How long has your niece lived with you? Determine the length of time the niece has resided with Mark. This information is crucial in assessing the residency requirement for claiming the EIC and CTC. How do you provide support for your niece? Inquire about the financial support Mark provides for his niece, including expenses related to food, clothing, shelter, education, and healthcare. This will help determine if he meets the support test for claiming the EIC and CTC. Does anyone else provide support for your niece? Ask if there are any other individuals or entities that contribute to the support of Mark's niece. This information will help ensure that Mark is meeting the support test and is the appropriate taxpayer to claim the EIC and CTC. By asking these additional questions, you can gather more information to determine the eligibility of claiming Mark's niece for the EIC and CTC. It is important to thoroughly assess the situation and gather supporting documentation to ensure compliance with tax regulations. Now, let's have another example. Sarah earned $8,000 and states she lived with her parents during part of the year. She wants to claim her biological son for the EIC and CTC. What additional questions would you ask Sarah? Here are great additional questions to ask Sarah. How many months did you live with your parents? This will help determine the duration of Sarah's residency with her parents and whether it meets the necessary criteria for claiming the EIC and CTC. Does the biological father contribute any support for your child? Understanding the financial contributions from the child's biological father is important to determine if Sarah meets the support test for claiming the EIC and CTC. Did your parents provide support for you and your child? Inquire about any financial support Sarah received from her parents during the year, as this may affect her eligibility for claiming the EIC and CTC. Do you have any additional income? It's essential to ascertain if Sierra had any other sources of income besides the $8,000 she earned. This will ensure accurate reporting and compliance with the income requirements for claiming the IKE and CTC. By asking these additional questions, you can gather more information about Sierra's living arrangements, financial support, and overall income situation. This will enable you to determine her eligibility for claiming the IKE and CTC accurately. Remember, it's important to gather supporting documentation and review all relevant factors to ensure compliance with the tax regulations.
All right, y'all. So once again, a lot of those questions, a lot of you guys will already have coming in knowing, um, you're going to eventually create a sheet for your client, an intake sheet. So a lot of these questions that she's asking, you can actually put on that intake sheet if you like. Of course, you can ask out of your mouth as well. A lot of clients you'll probably already have knowledge of anyway. The situation as far as splitting and switching kids every year and all of that stuff is very rare because it could get sticky. It could cause the IRS to red flag, ask for verification, do all of those things. So when that happens, the software allows you to attach any type of agreement from court, any of those type of things. But for the most part, most parents they'll try to keep it to where one person's claiming it, parent's claiming them, and of course they have their own situations because it is easier. When you're constantly switching parents or grandparents or whatever, it can definitely set off a red flag, and we want to prevent those because red flags don't get us paid. When it's a red flag, they send that letter. We don't get paid until they get paid. So it's in our best interest to prevent any red flags if we can. All right. So we got one more section before we shut it down for about 10 to 15 minutes. It's the American Opportunity Tax Credit, which is very, very major. I really urge you guys to pay attention. All right, give me one moment.
AOP section. This section provides a valuable tax benefit for eligible students pursuing higher education. However, there are certain common errors that taxpayers may make when claiming this credit. It is important for tax professionals to be aware of these errors and guide their clients to avoid them. In this section, we will discuss the most common mistakes associated with the American Opportunity Tax Credit and provide insights on how to prevent them. Let us start. As tax professionals, it's important to be aware of the most common errors associated with the American Opportunity Tax Credit, AOC, to ensure accurate and compliant tax filings for your clients. Let's explore these errors in more detail. Claiming AOC for a student who did not attend an eligible educational institution. To qualify for the AOC, the student must be enrolled at least half-time in a program leading to a degree, certificate, or other recognized educational credential. It's crucial to verify that the educational institution meets the eligibility criteria before claiming the credit. Claiming AOT for a student who did not pay qualifying college expenses. The AOT can only be claimed for qualified education expenses paid by the taxpayer or the student. It's essential to review the documentation, such as tuition statements or receipts, to ensure that the expenses meet the requirements for the credit. Claiming AOT for a student for too many years. The AOT can only be claimed for a maximum of 4 tax years per eligible student. It's important to track the number of years the student has claimed the credit and ensure that they are still within the allowable timeframe. Preparer did not ask for Form 1098-T for proof. Form 1098-T, provided by the educational institution, contains important information about the student's qualified education expenses. It's crucial to request and review this form to accurately calculate and substantiate the AOT. By being aware of these common errors, you can ensure that your clients properly claim the American Opportunity Tax Credit and avoid any potential issues or penalties. Next, let's move on to the next section where we'll discuss the questions to determine AOT. When assessing eligibility for the American Opportunity Tax Credit, ADOTC, it's important to ask your clients the following questions. Did the qualifying child attend college? Confirm whether the student attended an eligible educational institution, such as a university or vocational school. Was the qualifying child at least a half-time student? Determine if the student was enrolled for at least half of the normal full-time workload for their course of study during the tax year. Did the qualifying child receive Form 1098T? Request Form 1098T from the educational institution, which provides information about the student's qualified education expenses. How many years has the taxpayer claimed this credit? Determine the number of tax years the taxpayer has previously claimed the AOT for the same student. Remember that the AOT can be claimed for a maximum of 4 tax years per student. Is the student under the age of 24? Verify the age of the student to ensure they meet the age requirement for the AOT. Was the student convicted of a felony drug possession or distribution before the end of the tax year? Inquire about any felony drug convictions of the student, as certain convictions may impact their eligibility for the AEOTC. By asking these questions, you can gather the necessary information to determine if your client qualifies for the AEOTC and provide accurate tax preparation services. Next, we'll discuss the consequences of filing AEOTC incorrectly. Filing the American Opportunity Tax Credit, AOT, incorrectly can have several consequences. It's important to be aware of these potential outcomes to ensure accurate and compliant tax preparation. Here are the consequences. Client must pay back the difference in income plus interest. If the AOC was claimed incorrectly and the taxpayer received a higher credit than they were eligible for, they will be required to repay the excess amount. This repayment includes any interest that may have accrued. Due diligence interest and penalties due to recklessness. Failing to exercise due diligence when determining eligibility and claiming the credit can result in interest and penalties. The IRS may impose these charges if it is determined that the taxpayer was reckless or negligent in their tax preparation practices. Disciplinary action by the Office of Professional Responsibility, OPR. Tax professionals who consistently make errors or engage in unethical practices when filing the AOC may face disciplinary action from the Office of Professional Responsibility, OPR. This can include penalties, suspensions, or even disbarment from practicing before the IRS. It is important for tax professionals to exercise due diligence and maintain proper documentation to support the claims made. By doing so, you can help your clients avoid these consequences and ensure compliance with tax regulations. Next, determining head of household or HOH. Determining head of household HO status is an important aspect of tax preparation. To qualify as HOH, the taxpayer must meet certain criteria. Here are the key requirements. Unmarried on the last day of the year. The taxpayer must be unmarried, which means they are not legally married or are considered unmarried due to separation or divorce on the last day of the tax year. Have at least one qualifying dependent. The taxpayer must have at least one qualifying dependent, such as a child or relative, who lived in their home for more than half the year. The dependent must meet certain criteria specified by the IRS. Pay for more than half the cost of keeping up the home. The taxpayer must have contributed more than 50% of the total expenses required to maintain their home, including rent or mortgage payments, property taxes, utilities, and other related costs. Top of that, asking specific questions about the taxpayer's marital status, dependents, and household expenses will help ensure the correct filing status is claimed. Next, we'll discuss the head of household documents for tax professionals when assisting clients with HOH filings. When determining the head of household (HO) status for a client, it is important to gather supporting documentation to substantiate their claim. Here are some key documents that can be used to support a HOH filing. Divorce decree, if applicable. If the client is divorced or legally separated, a copy of the divorce decree or separation agreement can provide evidence of their unmarried status. Utility bills. Utility bills, such as electricity, water, or gas bills, can help establish that the client pays for the cost of keeping up the home. Lease agreement or mortgage payments. Providing a copy of the lease agreement or mortgage payment records can demonstrate the client's financial responsibility for the home. Property taxes. Documentation of property tax payments made by the client can further support their claim as the head of household. Letter from social services. If the client receives assistance or benefits from social services that require proof of residence, a letter or statement from the agency can be used as supporting documentation. School records. If the client has dependent children, school records such as enrollment or attendance records can establish their presence and residence in the client's home. Medical records. In certain cases, medical records indicating the client's address or the address of their dependents can be used as additional evidence of residency. These documents, among others, can help substantiate the client's claim for HOH status. They serve as evidence to support the filing status and ensure compliance with tax regulations. Next, we'll discuss the questions to determine head of household. To determine if a client qualifies for the head of household (HO) filing status, you should ask specific questions to gather relevant information. Here are some questions to help determine HOH eligibility. Are you single? This question helps establish the client's marital status, as being unmarried is a requirement for HOH status. Are you married? If the client is married, they generally cannot claim HOH status unless they meet certain criteria, such as being considered unmarried for tax purposes due to a legal separation or non-resident spouse. Do you have children? Having a qualifying dependent is an essential requirement for claiming HOH status. This question helps identify if the client has dependent children. How many months did the child live with you? To qualify for HOH status, the client's qualifying dependent S must have lived with them for more than half the year. This question helps determine if the client meets this residency requirement. What documentation do you have to prove the child lived with you? Requesting documentation such as school records, medical records, or other official documents can help verify the residency of the dependent S in the client's household. Does anyone else live in your house? It is important to determine if there are any other individuals living in the client's home, as it may impact their eligibility for HOH status. Certain relatives or non-relatives may qualify as an additional qualifying person under specific circumstances. Do you live with another taxpayer? If the client shares a residence with another taxpayer, it can affect their eligibility for HOH status. Understanding the living arrangements helps determine if they meet the criteria for claiming HOH independently. By asking these questions, you can gather the necessary information to determine if a client qualifies for the HOH filing status. Remember to document their responses and retain any supporting documentation to ensure compliance with due diligence requirements. That's the end of this section. Next is the best practices. See you there.
All right, y'all. Sorry about that. I'm muted once again, but that was a very key section. Our next section will be the income section, so I'm going to give you guys a break, and then we'll come back to that in about 10 minutes. All right, we'll come back to that about 10 minutes. That's the section people usually really want to watch. So hopefully that'll be something that you guys will take. But hopefully you guys got a lot from that, because a lot of stuff that she talked about will help you determine if they qualify for those things. And you want your client to qualify for as many credits as possible. The more forms you do, the more money you make. Some people charge per forms, you know what I'm saying? So each form, American Opportunity Tax Credit, Schedule C, this is all money. All right. So if they're eligible and you're able to do it, you really want to dig in and get that done. All right. Once again, sorry I was just unmuted briefly, but once again, I will see you guys back in about 10 minutes, and we will do our last section, which is income. All right. Thank you.